Okay, I agreed on the total investment amount, but now value the company differently. What can I do? So we've identified the value of the company at the term sheet level. Valuation has changed at the time before we signed the agreement. Is there anything that I can do about it? Well, because term sheets are not legally binding documents, you can reopen discussions, so you're not bound by it. But what happens if you've signed your transaction documents and now the valuation changes? What can you do? Typically, that you will really not see adjustments after signing the agreement, so you're kind of like locked in and stuck. So the message to founders, to startups is be very, very comfortable with the valuation, because once you sign the agreement, you're locked in. And this could have long-term repercussions, because today you sign valuation, you may say, okay, even if it's varied a bit, you can live with it. But for future rounds of funding, if you got that initial valuation wrong, you could go for a down round for your Series B or C, and that's where you get further diluted, and that's what you need to avoid. So valuation is a very, very important concept.
So actually, this is an interesting point. We sometimes tell founders to not be too greedy, because when you manage to get too high a valuation, as Jo Yan mentioned, but your numbers your user acquisition is slower than you represented to the investor, and you need money, your valuation will drop because you managed to managed to persuade one investor. wrong word. Persuade. You have to persuade, but the next investor may not be so persuadable, you know. So, and also, if you come in so hard with the money, you tend to scare off. But there's no hard and fast rule or science about valuation, right? People always ask us. First of all, we're lawyers, so accountants maybe, but really, there's no science to how do you value a startup. How do you can't use market comps, you can't use discounted cash flow, and what if it's a cutting edge technology, and different stages, right? How do you value? So, the point I'm trying to make is don't be too greedy. Be realistic about your valuation. Yeah. Sorry.
There are mechanisms for that will arise in the conversion stage. So I think we have to differentiate 2 points in time. The valuation at the time of investment, the valuation at the time of conversion. So yes, time of conversion, there may be adjustments, but here we're talking about the first part, time of investment. Okay.
Should we talk about conversion, or is it another
that's
point?
in the other slides. Yeah. Sure. I see.
That's a good question, especially if there are a lot of fluctuations, right? Generally, because there's not a lot of time gap between when you sign and completion, right? Mm-hmm. Unless you are getting investments in, give me a wildly fluctuating.
The ringgit.
I'm staying out of this one. Maybe an African, if anyone from African country, maybe a banana republic. But generally, if US dollars, Malaysian ringgit, Singapore dollars, generally I think the currency risk is not so high, except if,
Yeah. Well, you could always, it depends on where the funds are coming from. It could have been just, the history could have been the company saying, I need $1 million, let's say Sing dollars. And then and you're prepared to commit the $1 million Sing dollars as the investor, but it's just a question of for how many shares. And that's where the exchange rate could be an issue, because your starting point is from the perspective of 1 million Sing dollars. Perhaps to mitigate that risk, you flip it around now. If your operating company is doing business in ringgit, start the basic premise in ringgit. And then your exchange risk from an investment perspective is kind of like on your side already, because you commit to, you fix it in a ringgit denomination. Otherwise, another way of having clarity is to also determine what is the exchange rate ratio, what is the source of the exchange rate ratio that you're looking at, whether it's based on a central bank ratio, central bank rate, or some other commercial bank rate that you are banking with.
Or you just fix it in the contract.
Or you just fix it in the contract, based on some weighted average of the few days before, the few weeks before, typically few days before. Should I be looking at valuation of the company as a whole or valuation on a per share basis? I think from the founder's perspective, you should look at it from a per share basis. So let's say day one, you value your company at 10 million, but you own, let's say, 80% of that company. Another day, it's now valued at 100 million, but you only own 1% of it. When you do the maths, it may not work in your favor, even though the valuation of the company is a lot larger. So from a founder perspective, always keep in mind how much do you own by number of shares and how much is it worth on a per share basis. Don't get distracted by the valuation of the company as a whole.
And some of you, this is a good time to share this. Some of you may have joined startups before or are going to join startups where they will give you some options. Then they say, I give you 10,000 shares. Then to you, wow, 10,000 shares. Then, you get 10,000 shares and then you find out there are like 10 million shares, right? So what's 10,000? I can't even do the math of 100 million. So, leading to this, it's the percentage. And don't forget, some startups do some pretty funky stuff. They give options, they give convertible securities. So you have to bear that in mind as well.
Yeah, but also keeping that in mind, if you're a minority shareholder, you don't have a significant stake in the company. Let's say you own 1%, 2% in the company. Let's say you own 1% or 2% of Uber. From an economic perspective, wow, that's a lot of money in return. But from a management decision-making perspective, that might not be much because you're not going to sway any votes based on 1%, 2% shareholding. So if you're looking at it from an economic perspective, always go back to, put on a per share basis calculation. But if you're looking at it from a management decision-making perspective, then the percentage matters. So if you're just an employee who works hard and gets your ESOS, I think the percentage issue could be ego thumping, but always go back to what is it worth on a per share basis. But if you're the CEO, you're the driver, you're the founder, then percentage will be relevant to you. And post-money valuation in the term sheet. Yes, pre-money valuation, that's for clarity as to what is the agreed valuation today. Post-money valuation is just the aggregate of pre-money valuation plus the investment amount. So all that is there just for clarity purposes. It hardly gets negotiated. I need the investment quickly. Do I really need to fulfill all the conditions precedent? Right? So you've agreed on the valuation, you've agreed on the product, the RCPS, you've agreed on the terms. But as investors, they say, hey, that's a lot of money you're asking for. I'm prepared to give you all of it, provided you fulfill certain milestones. Startup says, I desperately need the money now. Certain milestones cannot be fulfilled within the agreed timeline. What can I do? So from a drafting perspective, as a startup, what you should ask for is waivers of those conditions precedents. But you have to bear in mind, these waivers are always at the discretion of the investor, rarely at the discretion of the founder. Okay? Unless you can sort of give some comfort to the investor that I have a side arrangement, let's readjust the timelines, let's get an amendment to the agreement, then that's fine. But essentially, you have no control over the disbursements of the funds. The funds are always sitting with the investors. So if you don't meet their milestones, then too bad.
Next brings me to talk about tranched payments. Investors quite often would, you read in the papers or Tech in Asia, it's a 3 million, financing. But a lot of times 3 million does not cross, immediately, because it's still a fair amount of money. So, like Joanna was mentioning, there are certain milestones in terms of perhaps revenue, perhaps number of customers, new customers. Then only if you meet that, then the second tranche of money comes in. So that's something to bear in mind. It's quite common, especially when the valuation was something that you and the investor really spend a lot of time arguing on.
Yeah.
So that's their way to hedge their risk. If you don't meet the numbers, I'm not going to pump in money. So if you say that your company is really doing so well, we will see. So that's getting quite common actually.
Yeah. You can also distinguish conditions precedent with conditions subsequent. Conditions precedent are for items that are absolutely crucial to the investor before the funds can be released. But you don't want to have a long list of CPs before the funds are released. So as a founder, if you can differentiate, itemize what is very crucial and not so crucial. Not so crucial, maybe put it as a condition subsequent. I will still do it, I promise I will do it, but don't let that performance affect the disbursements of the funds.
So yeah, it is actually, I should mention, it is quite important that those milestones are realistic, that you can meet them. Don't promise a lot of things and they set the milestone really high, and when the time comes, the money's not going to come in. You sign the contract and all, but you didn't meet it, and they're not going to waive it.
Yeah.
So again, be realistic. Make sure that more or less I can get it. I mean, if it's within 10%, range, I think sometimes they'll be okay, the next one you better do better.
Yeah.
So again, this is pretty key.
Yeah. And make sure your conditions precedent are extremely specific, that you can easily identify whether it has been fulfilled or not. You can't have a very subjective condition precedent where we reach, let's say you want to have number of subscribers. Be very specific. I want to have 1,000 subscribers by when? That's very specific, as opposed to, I want to have 1,000 subscribers, full stop. By when, open-ended,
Yep.
Okay, let's just move on.